Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. This is episode 107 of the Northbound Wealth Management Podcast, or the Northbound Wealth Podcast Weekly Market Insights. Try to do this every week. And today is May 20th, and stocks roared higher last week, powered by upbeat trade news and tame inflation reports. So the S&P 500 index rose 5.27% last week, closing at around 5,958.38, while the NASDAQ Composite Index spiked 7.15%, closing at 19,211.10. The Dow Jones Industrial Average added 3.41%, closing at 42,356.20. And the MSCI EFA Index, which tracks developed overseas stock markets, increased 0.80%. So not as much as the U.S. Last week, that is. S&P Dow erased year-to-date losses. So stocks pushed higher on Monday of last week as investors cheered weekend news that the U.S. and China temporarily agreed to back off steep reciprocal tariffs. The week started with a relief rally as the Trump administration unveiled a trade deal with China just days after announcing another such deal with the UK. The deal between the U.S. and China calls for a 90-day suspension of reciprocal duties on each other's goods. The two sides have been in a trade war since President Donald Trump's announcement of sweeping new tariffs early last month. On Friday, Trump said the U.S. will unilaterally set tariffs for many other countries soon. Quote, "We will be telling people what they will be paying to do business in the United States," end quote, he said. That was Trump, that is. Still, stocks held on to week's gains, especially the technology sector, as a number of corporate deals were signed amid Trump's Middle East tour. Then, a mild inflation report for April, the slowest annualized consumer price index, or CPI, reading in 4 years. I mean, that's got to be good news, right? Boosted markets on Tuesday. Tech stocks powered the rally as the S&P 500 closed trading in the green for the year. All of the S&P 500 sectors posted weekly gains. Technology rose 8.1%, followed by a 7.7% gain in consumer discretionary, a 6.6% rise in communication services, and a 5.5% increase in industrials. Energy and financials rose more than 3% each, followed by smaller gains in other sectors. So Supermicro had the largest percentage increase in the tech sector, surging 44% as the company signed a memorandum of understanding with a Data Vault to develop hyperscale AI campuses in Saudi Arabia. The agreement depends on finalizing one or more binding contracts, with the minimum market value of the planned products estimated at $20 billion, it said. First Solar was also strong, soaring 27% amid a number of positive analyst actions, including a rating upgrade from Wolf Research. First Solar may benefit from a favorable U.S. utility scale solar tax policy, as only, quote, relatively minor changes, end quote, were proposed in the Republican budget, UBS said in a note to clients while raising its price target on the stock. The consumer discretionary sector was boosted by a 17% jump in Tesla shares. Following a trade deal between the U.S. and China, the electric automaker intends to ship components from the U.S. to the U.S. from China for Cybercab and semi-trucks by the end of May, according to a Reuters report. In communication services, Fox's shares climbed 12% as the media company reported a surprise increase in its fiscal third quarter earnings. The company's quarterly revenue topped market estimates as the Super Bowl drove sharp gains in its advertising sales. That's this past Super Bowl. Healthcare was the weakest sector, eking out a gain of just 0.3%. United Health had the largest percentage drop in the sector, falling 23%, As a Wall Street Journal report citing people familiar with the matter said the company's facing criminal investigation by the U.S. Department of Justice over possible Medicare fraud tied to its Medicare Advantage operations. The company said it hasn't received any notification from the DOJ. Friday was the Dow's turn to erase year-to-date losses and get back in the green, while the NASDAQ and S&P 500 notched a 5-day winning streak. So year-to-date, trailing NASDAQ is down 0.78%, S&P is up 1.09%, MSCI EFA is up 14.57%. So really international outperformance over U.S. this year. Dow Jones Industrial Average basically flat at 0.04% to the positive. But over the longer term, the 1 year and 5 year, the U.S. is dramatically and significantly outperformed international markets, let alone like even longer term, 15, 20 years. 10-year Treasury note, 4.43%. That is up from a month ago of 4.29%. So keep that in mind, 4.43% on the 10-year note. Thank you, Stock Charts, and thank you, Y Charts, especially Y Charts, for this data and information. Let's keep going. All eyes on economic data. The retail CPI and wholesale inflation reports, the producer price index, were mild, although most economists didn't expect tariffs to impact prices in the first month of implementation. Retail sales ticked up slightly as expected, while industrial production and housing starts showed signs of tariff impact. Expect traders to continue to closely watch economic reports to better understand whether tariffs are showing up in the data. So tariffs is another word for taxes, okay? This week, key economic data. So the New York Fed President, John Williams, Dallas Fed President, Lori Logan, Atlanta Fed President, Raphael Bostic speak. Leading economic indicators, e-commerce retail sales. Tuesday, Richmond Fed President Thomas Barkin, Raphael Bostic, and Fed Governor Kugler speak. Financial Markets Conference. Wednesday, Thomas Barkin speaks. 20-year Treasury bond auction happens. Thursday, existing home sales, jobless claims. That's the weekly number. The PMI, Composite Services and Manufacturing. John Williams speaks, and Fed balance sheet is revealed or communicated. And then Friday, new home sales, Kansas City Fed President Jeff Schmid and Fed Governor Lisa Cook speak. Thank you for Investors Business Daily economic calendar for that. All right. So this week, notable companies reporting earnings. The Home Depot, Palo Alto Networks, that's Tuesday. Wednesday, the TJX companies, Lowe's companies. Thursday, Intuit, Analog Devices, TD Bank, and Workday. So we'll be keeping track of that for you. In tax tip of the week this week, the IRS may send you one of two notices if your filed returns don't match their records. So they're going to reconcile what they have with what you have. Have you ever wondered what happens if the information on your tax return doesn't match IRS records? The IRS mails out two notices, CP2100 and CP2100A. To banks, credit unions, businesses, and payers who may have made a mistake on the return. The IRS mails these notices out twice yearly in September or October and April of the following year. Payers may receive a notice if their return lacks a taxpayer identification number, has an incorrect name, or both. The notices also tell payers that they are responsible for backup withholding. This information is not suitable for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional. And this tip was adapted from irs.gov. All right, let's move on to the next segment. Hello, everybody. This is Brent Foster, and I came across this article that was published by the editor of the AAII Journal, which is the American Association of Individual Investors Journal, Charles Rotbleu. He's a CFA. He's a vice president and editor-in-chief, basically, of that publication. And from time to time, I come across articles that are, I think, worthy enough and good to share with everyone. So this is one in which he wrote about 16 red flags to watch for in a company's financial statements. So what he says is use our handy financial health checklist to spot potential problems in a stock before they cause you to incur a large loss. I kind of like this, so let's dive in. See, analyzing financial statements can help you avoid stocks with significant underlying risks. The numbers within the statements can reveal deteriorating trends, excessive debt, customer problems, and other issues that may lead to a drop in the stock's price. The potential problems identified may be ones either not mentioned or downplayed by corporate executives. Whereas a CEO will try to position their company in the best possible light, the numbers reveal trends as they are, good or bad. Warning signs often show up in the financial statements before they make headlines. In this installment of our financial statement analysis series, we walk through 16 red flags that may signal business or financial trouble. Recognizing these indicators may help you spot potential problems before your portfolio is harmed by them. Cash flow red flags. So, cash flow refers to how much cash a company has brought in and how much it is paid out. Unlike earnings, which are an accounting figure, cash is required for a company to operate, grow, pay dividends, and repurchase stocks. The cash flow statement is a good place to look for potential financial red flags because it's harder for a management team to manipulate than the income statement. 3 indicators can reveal if a company is incurring challenges in converting earnings into cash. So, number 1, operating cash flow is negative for consecutive quarters. Cash flow from operating activities tells you how much cash is realized or spent by normal day-to-day business operations. It should be positive over most periods. Operating cash flow can be negative for a particular quarter due to the timing of transactions. A common example is a large purchase of inventory ahead of fulfilling a customer's order. CFOs often disclose such transactions during the quarterly earnings conference call. Seasonality can also play a role. Holiday shopping patterns can cause retailers to have negative operating cash flow during their third quarter and large positive cash flow during their fourth quarter. When operating cash flow remains negative for more than one reporting period, it often indicates that the firm is spending more than it's bringing in from business activities. Such a situation is not sustainable. A company will need to reduce the size of its operations, secure more debt, and/or conduct a secondary offering of shares to raise more capital to stay afloat. Number 2, net income exceeds operating cash flow. Net income exceeds operating cash flow. So, when net income consistently outpaces operating cash flow, it raises questions about the persistency of earnings. This mismatch is typically due to an over-reliance on accrual accounting. Accrual accounting recognizes transactions when their economic benefits become probable. Cash accounting, in contrast, recognizes transactions when cash exchanges hands. Accrual accounting makes it easier to project future earnings. Problems arise with accrual accounting when future revenue that is expected to offset previous expenditures is not realized. While some variance between earnings and operating cash flow is not a cause for concern, sustained higher net income relative to cash flow from operations can indicate that the company is boosting earnings with accounting entries rather than real economic activity. This can lead to future write-downs. Analyze the cash flow statement and footnotes to understand the source of the discrepancy. In some cases, companies may use aggressive assumptions around revenue recognition or underestimate or understate reserves for bad debts to prop up net income. Okay, number 3, free cash flow is consistently negative or declining. So free cash flow is cash available to spend on activities not directly related to the company's ongoing operations. It is calculated by subtracting capital expenditures, which is called CapEx, and dividends paid from cash flow from operating activities. Negative or declining free cash flow is a signal to investigate further. Spending on a new facility to expand operations or pay down debt can temporarily cause free cash flow to be negative. Ongoing CapEx, listed in the cash from investing activities section on the cash flow statement, that are not accompanied by growth trends on the income statement are very problematic. They imply that a company is overspending. All right, so Liquidity red flags. Liquidity refers to a company's ability to meet its short-term obligations. Weak liquidity often precedes more serious financial issues, particularly during downturns or when credit conditions tighten. Analyzing a company's liquidity can also reveal problems with a company's customers. This is a warning sign about problems within the business and/or its industry. So number 4, this is the liquidity red flags. Current liabilities exceed current assets. Current liabilities exceed current assets. A current ratio below 1.0 indicates that a company cannot meet its short-term obligations with its short-term assets. Timing or seasonal issues can cause the current ratio to be temporarily depressed over certain quarters. An unexpected or a consistent trend of current ratios below 1 implies a company may be relying heavily on short-term borrowing or delayed payments to suppliers to keep operations running. Number 5, quick ratio below 1. The quick ratio or acid test ratio is a stricter measure of liquidity than the current ratio. It excludes inventory and prepaid expenses from current assets since neither can quickly be converted into cash at stated values. Inventory can be devalued from its stated book value because of obsolescence or because demand for it is low. A quick ratio below 1 means the company may not be able to pay off its current liabilities without securing new financing or selling inventory at a loss. Persistent low ratios suggest that the company is operating without a sufficient liquidity buffer. Number 6, declining inventory and receivables turnover ratios. The inventory turnover ratio reveals whether inventory is being converted into sales or is languishing in the warehouse or on store shelves, so they're not selling through it. A decline in this ratio indicates weaker demand by customers, a loss of market share to competitors, and/or obsolescence. The receivables turnover ratio measures how quickly customers pay their invoices. Declines in this ratio suggest that the company's customers are taking longer to pay. This could be due to a shift in the customer base. Slowing receivables or lower receivables turnover ratios may also signal that the company has loosened its credit policies. The company's customers are seeing weakening demand for their product, or the company's customers are struggling financially. A decline in this ratio is particularly worrisome for companies whose revenues primarily come from a small number of key customers. Companies with seasonal or cyclical sales trends may see fluctuations in both turnover ratios, but persistent declines are often symptomatic of underlying problems. Number 7, rising accounts payable turnover ratios. So accounts payable found in the current liabilities section of the balance sheet are the amounts a company owes to its vendors and other businesses it uses. Quarterly fluctuations in the accounts payable turnover ratio can occur, but an ongoing or significant decline in the ratio is a cause for concern. It suggests that the company is delaying payments to suppliers to conserve cash. A pattern of slowing accounts payable turnover ratios alongside weak cash flow and other liquidity issues is a big red flag. Let's talk about debt and solvency red flags. In this article, the inability to service debt can trigger serious problems. Dividends and buybacks may be suspended, growth initiatives may be delayed or canceled, and in extreme cases, the company may be forced into bankruptcy. So we'll go to number 8, interest coverage ratio near or below 1. So 1.0. The interest coverage ratio measures a company's ability to meet its debt obligations. Ratios near or below 1 occur when a company is either barely covering its interest payments with earnings or not covering them at all. So if a loss is reported by a company with interest expense, the ratio cannot be calculated, by the way. So debt covenants may require the interest coverage ratio to be above a certain level. Even the risk of violating those covenants can force a company to halt expansion plans and/or cut its dividend. Failure to service the debt puts a company into default. Companies may seek to raise additional financing to meet their obligations, a warning sign of a debt spiral. I know of a couple of companies that are in that debt spiral at the moment. Number 9, rising debt to equity ratio. Companies taking on more debt will see their debt to equity ratio rise. This can be acceptable if the company is financing reinvestment or growth through borrowing rather than through cash or equity. It becomes problematic when the ratio is rising, but revenue and earnings growth does not follow. A debt to equity ratio that is significantly higher than a company's peers is a potential red flag. Comparing this ratio over time can help investors spot creeping leverage, which may not be immediately obvious from the absolute dollar figures alone. Number 10, Altman Z-score below 1.8. So a lot of you may not know about this type of stuff. Well, I think it's good to stretch the mind a bit here. So the Altman Z-score uses 5 indicators: relative working capital, retained earnings, earnings before interest and taxes or EBIT, equity and sales to assess the probability of a company going bankrupt or incurring significant financial distress. Scores below 1.8 signal a high risk of going bankruptcy or at least incurring financial distress within the next 2 years. So that's a good one to kind of mold together different financial ratios to assess the financial condition of a company. So profitability and competitive performance. Declining profitability is a financial red flag because it generally leads to less cash available to be reinvested in the company or to pay down debt. A decline in profitability is also often the first problem to start dragging a stock's price down. So let's dive into number 11. Revenue and profit trends are declining. Revenue declines can be attributed to cyclical factors or seasonal factors when viewed on a sequential quarterly basis. They can also reflect problems with the company or its industry group, or a combination of cyclical company and industry problems. Regardless of the cause, a financial red flag is raised about the company facing demand issues, especially when declining revenues are paired with shrinking profits. Investors should be particularly concerned when the trends indicate that the downturn is not temporary. Number 12, profit margins are narrowing. So narrowing gross margins occur when a company realizes a smaller gross profit on every good sold or service provided. The decline in gross profitability can be caused by competitive pressures, higher costs, weakening demand, increased inefficiencies, or a combination of these factors. Declining revenues and narrowing gross margins are particularly worrisome because they point to an inability to sell goods at favorable prices. Operating margins not only consider the cost of revenues, but also overhead costs, depreciation and amortization costs. Operating margins that are shrinking faster than gross margins occur when the company is having problems managing its operating costs. Taken together, shrinking profit margins often indicate challenges for managing both input costs and internal expenditures or expenses. Number 13, revenue and profit trends are out of sync with industry peers, so you can compare them to the peer group. Comparing a company's revenue and profit trends to its peers will tell you whether the profitability issues are at least somewhat caused by industry or sector headwinds. Companies that are stagnating while their competitors are growing revenues and profits should be approached with caution. This divergence is especially telling when it occurs during periods of broader industry growth, unless it all can be explained. But then again, how do you trust it, right? It's good to see the data as well. Additional financial red flags. So this is an additional section. In addition to the aforementioned ratios and trends, there are a few other financial red flags to watch out for. Number 14, assets growing faster than revenues. Continued stronger growth in assets relative to revenues can tip you off to problems. Disproportionate growth in accounts receivable and inventory signals customer and demand problems, respectively. Disproportionate growth in fixed assets or intangibles suggests the company's expansion plans have been too aggressive. Number 15, dividend payout ratio approaching or above 100%. This is something I look at quite a bit for those who are value investors, dividend investors seeking income. High dividend payout ratios are not sustainable. Particularly worrisome is a high dividend payout ratio with low profitability ratios and or low to negative free cash flow. Unless earnings rebound, the company will be forced to cut its dividend. Regulated utilities are able to maintain high dividend payout ratios because of their rate agreements with utility regulators. Just keep that in mind. It's number 16, Piotrowski F score of 3 or less. So the Piotrowski F score evaluates a company's financial health based on 9 accounting-based criteria, including profitability, leverage, and operational efficiency. It works well for doing a primary assessment of whether a company is fundamentally weak, scores of 0 to 3, or fundamentally strong, scores of 7 to 9. Additional analysis should be conducted, especially if the score is low. So, in summary, financial red flags should not be ignored. It can be tempting to downplay a financial red flag, but investors do so at their own peril. An important factor is determining whether the concerning numbers and ratios are attributable to timing and cyclical trends or to company-specific problems. When uncertain, it is prudent to assume the latter. Look beyond the earnings releases and financial statements for more information. Earnings conference call transcripts and U.S. Securities and Exchange Commission filings, particularly Forms 10Q and 10K, provide useful context. Watch for cautionary signs such as frequent restatements of earnings, or not even late filings, for example. Management turnover, particularly CFO changes, because they're in control of the finances usually, and auditor or going concern warnings. If you see that, those are all red flags. Ultimately, the goal of financial red flag analysis is to spot potential problems before they cause you to incur a large loss or a bigger loss than you've already realized. All right. There you have it. If you want to have a case study for companies that have financial red flags, one of them is B. Riley Financial, ticker symbol RILY. If you look at that one, there are red flags all over it. And you can kind of get a good use case to apply some of the thinking that was just disclosed here. I really like this article. Very easy to understand, and good tips for those of you who are out there want to learn a bit more about financial statements and what to look for in companies. All right, on to the next segment. Thanks for listening. Let's kind of take a look at the first quarter 2025 earnings summary. So Palantir Technologies reported financial results for the first quarter ended March 31st, 2025. The company saw a year-over-year revenue growth and raised full-year outlook based on continued expansion in its U.S. businesses. Some of the key points are earnings per share adjusted were positive $0.13, matching the analyst estimates of 13 cents. Earnings per share adjusted were 13 cents, matching the analyst estimates. Revenue was $884 million, ahead of the $862 million estimate, and up 39% year over year and 7% quarter over quarter. U.S. revenue grew 55% year over year to $628 million, with U.S. commercial revenue up 71% year over year to $255 million, and U.S. government revenue up 45% year over year to $373 million. The company raised the fiscal year 2025 revenue guidance to 36% year over year growth and set guidance for U.S. commercial revenue growth at 68% year over year. So going deeper, CEO Alex Karp stated that Palantir is experiencing a shift in software adoption, particularly in the U.S., highlighting the rapid growth in U.S. revenue and commercial contracts. He described the company as delivering the, quote, operating system for the modern enterprise in the era of AI, and noted a raised revenue outlook for the full year. So how did Palantir's software and services perform by segment? U.S. commercial revenue reached $255 million. That's up 71% year over year and at 19% quarter over quarter, while the U.S. government revenue hit that $373 million marker, a 45% annual increase. The company closed 139 deals valued at $1 million or more, with significant gains in large customer contracts and total contract value. So there's a huge catalyst for the stock. Palantir reported GAAP income from operations of $176 million, 20% margins. Adjusted income from operations of $391 million, 44% margins, and GAAP net income of $214 million or 24% margin. Cash from operations was $310 million, 35% margin, and adjusted free cash flow was $370 million or 42% margin. Palantir ended the quarter with $5.4 billion in cash equivalents, and short-term U.S. Treasury securities. So they're got plenty of cash position and low debt. I think I saw like $244 million in debt. That's it. Palantir booked its highest ever quarter of U.S. commercial total contract value of $810 million, up 183% year over year, with remaining deal value in the U.S. commercial contracts of $2.32 billion, up 127% year over year and 30% quarter over quarter. Customer count increased 39% from the prior year and 8% from the previous quarter. So what was their forward guidance? They raised their full year 2025 revenue growth guidance to 36%. And they go on and talk about that. Palantir Technologies in the fourth quarter, they demonstrated notable growth in revenue, particularly in the U.S. market. And they kind of go, this particular report on the Motley Fool runs through all of that. So thank you, Motley Fool, for talking about Palantir a little bit. I think it's going to be a good one. I think that I heard Dan Ives talking about this. I agree with it. Part of the use cases across the enterprise space, I think that Palantir also is going to do really well. ServiceNow has already done well and it will continue to do well. That stock's trading above 1,000 a share. It remains to be seen how Palantir is going to do over the next, say, 5, 10, 15 years. But I'd imagine that they're going to do quite well. Salesforce did well. And they're a SaaS provider. I mean, it's low cost overhead on that type of business model. So I think that they'll proceed to keep going, especially if they stay on the front end of leading edge of AI and data analytics. So the applications across all these different commercial segments and government segments are going to be very key and crucial. And they seem to be in the driver's seat in that respect. I'm looking at trying to pick up the 800-pound gorilla, future 800-pound gorilla in the space. But it's not a recommendation for advice. I just like the company. I look at the financials. They're turning a corner, and they're on the front end edge of this space. So I want to make sure that clients and I are exposed to that and have the opportunity set in front of us. All right, stay tuned for the next segment. So I put this out on the blog. Is it smarter to buy or rent a second home? As summer approaches, your thoughts may drift towards escaping your daily routine. Whether your idea of a perfect vacation is sitting on a pristine beach, fishing in a mountain lake, or playing the back nine between pickleball matches, many of our clients have come to us over the years with the same question: should I buy a vacation home or just continue to rent? As financial professionals, our answer is it depends. Also, if you're a graduate, I know that's not a great answer. It depends. Renting a house for a week or two can be less expensive and time-consuming than buying a vacation property. Renting is a short-term commitment, while buying a second home often requires an ongoing investment of time and money. Renting allows you to choose different vacation destinations every year without maintenance and upkeep concerns. However, buyers can decide to rent out the property when they're not there. We caution our clients to consider the pros and cons before making decisions. While we aren't real estate experts, we've compiled some information that you may find helpful. Buying a vacation home. Non-financial considerations. Many financial considerations must be pondered with a vacation property. Will you buy it outright or take out a mortgage? Are you interested in renting it when you're not there? Will it impact your cash flow? There are also many non-financial issues you may want to consider, the most important being how a second home will affect your lifestyle. Here are a few more aspects to consider before signing on the dotted line. Like, how much time will you spend there? If you only intend to spend a few weeks a year there, is renting a better choice? The expense and hassle of owning a second home may not be worth it unless you stay a few months each year or enjoy the place. Over time, you can develop friendships and become part of the community, making your second house more of a home. Here's another one to consider. How does a second home fit into your travel patterns? So, by owning a vacation home, you may spend less time traveling to other locations. Consider whether focusing vacation time on one location fits your desired travel patterns. For example, if you believe you'll be happy spending all your free time in Florida, then buying might be the right decision for you. However, you may feel tied down to one place if you like to travel the world. Okay, so think about that. Consider these questions. Will a second home increase your stress? That's a big one. Before buying, be aware of the potential stress of owning a second home. Like your primary residence, you'll need to deal with utilities, maintenance, repairs, and other considerations. While you may find these issues worth the benefits of owning a vacation home, you should enter ownership with your eyes wide open. Here's another one. Will purchasing a vacation home enhance your experiences and relationships? So, if your vacation home becomes a hub for family and friends to visit and for you to engage in social activities and adventures with them, owning a second home can increase your happiness. Clients who enjoy their vacation homes the most tend to create memories through experiences with family and friends at their second homes. On the other hand, buying a vacation home primarily as a relaxing retreat may not add much to your overall happiness, despite the weather and scenery. Here's another one. What are the potential advantages of buying a vacation property? So, there are many good reasons to buy a vacation home. After considering the aforementioned non financial factors that we just talked about, it may be the right course of action for you and your family. Here are some potential benefits, like possible real estate appreciation, so capital appreciation. One potential advantage to buying a vacation property is that the value of the real estate may increase over time. Of course, there are no guarantees, and your property could lose value. Renting costs for your vacation. So, owning a property in a vacation spot means you won't need to pay for weekly accommodations. Perhaps generate rental income. That's another one. Another benefit to buying a vacation property is the opportunity to generate rental income. If you choose a vacation home in a bustling short-term rental market, you may have the chance to rent out your place when you're not in town. Convenience. Owning a vacation home can be more convenient than arranging short-term rentals. It's also more familiar, comfortable, and allows you to host friends and family, unless you can get that repeat one every year, which can happen also. Retirement. A vacation home can be part of your retirement strategy. Some clients have used their second homes in later life and moved in permanently. So maybe you buy the lake house and you sell the house that's in the suburbs or the city and move out to the lake house property full time because you're retired. Potential disadvantages of buying a vacation property. So here's the other side of that coin. Of course, there are the pros and there are cons. While we don't want to rain on everybody's parade as financial professionals, we strive to provide a fair and balanced view. So here are some of the potential downsides of buying a vacation property. So, money management. Buying a property can be costly, especially a second home in an expensive vacation area. In addition to initial costs, there are also ongoing maintenance costs and other types of costs like HOA fees and things like that. If money is an issue, buying another house may not be your best choice. Financing. If you cannot self-finance your purchase, financing a vacation home can be challenging because of different mortgage requirements. A higher credit score and larger down payment are often required to qualify for a mortgage. So if you're not paying in cash, expect a more complicated financing experience than purchasing a primary residence. Usually they require 20% down or more on investment properties or second homes. Property management. If you plan to generate rental income when you're not using your vacation home, you may want to hire a property manager to find renters for you, collect rent, and clean the place. This could add up to 15% of the rental income in costs. So keep that in mind. Inconsistent rental income. So there's another downside. So rental income often depends on the season or certain times of the year. There are usually seasonal periods when one might rent. Vacation property rental income is impacted directly by the destination and its popular times, which can affect income. Also, usually during the popular times, when people want to be there, you actually want to be there. So there's that too. Lack of disaster aid. So FEMA disaster assistance is limited to your primary home where you live for more than 6 months out of the year. Second homes or vacation homes used as vacation rentals don't qualify for FEMA assistance. Thus, if hurricanes, wildfires, or floods destroy or damage your second home, you must rely on other options. So, like self-financing. Markets for luxury second homes. So, let's talk about that. While demand for luxury second homes rose during the pandemic, you may think that today's relatively high interest rates, tight inventory, and uncertain economic environment would have damaged the market. They haven't. Despite the numerous challenges hitting residential real estate, the luxury housing market has remained strong. According to the agency's 2025 Red Paper, the number of U.S. homes selling for $1 million plus increased by 5.2% in the first half of 2024, while the median price for high-end properties rose by 14.2% compared with the broader market, in which overall home sales fell by 12.9%. The median price increased by just 5% over the same period. So with more cash on hand and fewer financial constraints, wealthy home buyers are often less reliant on loans. According to the agency's report, home buyers paid cash for nearly half of all luxury homes sold in the first quarter of 2024. So if you're in the market for a high-end second home, you're in good company. Real estate company Picasso analyzed the markets with the most significant year-over-year growth in luxury second home transactions from 2023 to 2024 and average prices for second homes. They believe these second home destinations could see more growth even in this year, in 2025. As you'll see in the chart that I put out on the website, on the blog, Cape May County, New Jersey, with its Victorian charm and sandy beaches, ranked as the top spot for second home purchases in 2025, with Gulf County, Florida coming in as a distant runner-up. Suppose you're looking for a second home selling at under $1 million. Washington County, Utah, near Zion National Park, Coconino County, Arizona, near Flagstaff, and Cumberland County in south central Maine, along with the coasts, are popular locations. So I have this chart, top 20 vacation home markets in 2025, out on the blog. Go check it out. We've got, let's see, New Jersey, Florida, Massachusetts, Arizona, Hawaii, South Carolina, Rhode Island's in there. Montana's like 15th, Utah 16th, 18th, Deschutes County, Oregon, South Carolina, Maine. I don't see any real there's not that I can tell any Midwestern states. So it's mostly coastal states. Insurance considerations for second homes. Unless you have the resources to self-insure, you might want to consider homeowners insurance to protect your real estate purchase. Second home insurance is a specialized policy designed to cover properties that are not your primary residence. Policies differ because a second home may have additional risks not associated with your primary residence. Standard homeowners insurance for a full-time residence costs on average of $1,754 per year. But you might pay more for a second home insurance policy. For example, American Family estimates that vacation home policies are typically 2 to 3 times more expensive than home insurance for a full-time residence. The additional risks that cause second home insurance to be higher include vacancy periods. So unoccupied homes are more vulnerable to theft or damage. Location-based risks. So coastal or mountain properties may face specific hazards like hurricanes, floods, or wildfires. High-end property. So if your second home is a luxury property, consider high-value property insurance. And then rental use. If you rent to others, you may face additional liability concerns such as tenant-caused damages and liability for injuries sustained by renters or their guests. Banks will require that your second home be insured if you take out a mortgage. If you're paying cash, the insurance coverage you want, if any, is up to you. If you seek coverage, you should evaluate risks, compare providers, and determine if the policy aligns with your needs and property usage, including a vacation home in your estate. So if you buy a vacation home, consider what happens to the property after you're gone. If a family vacation home is part of your estate, you should put the time and effort into outlining your intentions for the next generation. Your heirs should know what they're getting and the time, effort, and resources they'll need to put into the property to keep it functioning well. You know your family's dynamics, and that not all of your heirs will have that same level of interest or involvement in the family vacation home. Thus, be mindful of this and flexible when creating your strategy. Consider working with your financial professional and estate team to determine the best way to transfer your vacation home based on your situation. Here are a few choices you may want to evaluate. Sell the house outright or gift it to one or more of your children. Establish a trust in which one or more trustees are responsible for owning and maintaining the property. Using a trust involves a complex set of tax rules and regulations. Before moving forward with the trust, consider working with a professional familiar with the relevant rules and regulations. Form an LLC or other legal entity where your heirs will be owners to follow specific governance rules and operating agreements and how the property is used. As financial professionals, we can offer insights into how your vacation house may contribute to your overall estate strategy. So keep that in mind. Tax implications of owning a second home. As we mentioned before, we're not tax experts, but we work well with people who are. We're outlining some general information, but it's not a replacement for real life advice. Consult your tax, legal, and accounting professionals for more specifics regarding your second home. If your second home is a residential home, you may be able to deduct mortgage interest up to $750,000 as long as the second home is the one that secures the loan. If your mortgage on your second home originated before December 16, 2017, you can deduct up to $1 million in mortgage interest. You can also deduct state and local property taxes up to $10,000 combined for all real estate taxes between your homes. If you rent your property for 14 days or less during the year, you may not need to report this as income to the IRS. If you rent your second home for more than 14 days a year, the IRS considers it an investment property. If your second home is an investment property, you may be able to deduct mortgage interest or real estate taxes on your personal income tax return. Still, you may be able to deduct those costs against your rental business income. When you sell your second home, you must be aware that you may not receive the same capital gains tax deduction when selling your primary residence. $250,000 for single filers, $500,000 for married filers. Renting a vacation home. If you have gone through all the pros and cons of buying a vacation home and are leaning towards renting, this approach also has two sides. Let's start with the positives. Potential advantages of renting a vacation home. Little responsibility. If you choose to rent a vacation home, your only responsibility is to leave the house the way you found it. None of the property maintenance or utilities fall onto a short-term renter to take care of, which means you can enjoy your holiday and then dump your garbage on the way out, turn out the lights, lock the door behind you. Variety of options. So renting vacation homes means renting a different home anywhere you go. You won't be limited to revisiting the same place over and over. Instead, you can change locations each time you go on vacation and experiment with the type of property to see what you enjoy best, in town or out of town, kind, friendly, or over 55, nightlife, or peace and quiet, etc., etc. Cost considerations. Renting a vacation home can be more affordable to go on various vacations in many areas. After all, you will not have to pay a mortgage, maintenance fees, or other charges. So, disadvantages of renting a vacation home. Anyone who has rented a vacation home knows that there are some downsides. Here are a few of them. Cost. In 2024, the expected average daily rate for U.S. vacation rentals is $326. This number will fluctuate based on the type of home you rent. A luxury rental could be significantly higher. It's not your space. So, when renting a vacation property, you live in someone else's home. For many people, it's never comfortable as staying in your own place. You may find problems with the house. It may not have all the features you're accustomed to, and you may need a learning curve to figure out how to use everything from the TV to the thermostat. Availability. You may need to book your own vacation homes well in advance during peak seasons. Chances are you want to go away on the same time of year as other people. Other people have that same idea. Availability can be problematic if you book too late or the area is extremely inconvenient. So renting a vacation home can be a hassle. You have to choose the home, make sure it's available when you want, and then go through the booking process with the owner, the property manager, or a third-party website. If anything accidentally breaks during your stay, you'll also be liable to cover it. There can also be unexpected fees that drive up the price. So finally, make your decision carefully. I'm sure you've gone on vacation to a terrific location and fallen in love with it. The experience might have been so wonderful that you thought about buying a home to spend more time there. That's how the timeshare industry became so popular in the 1970s and 80s, catering to impulse buyers. However, it's important to remember that while you might be swayed by the most enjoyable aspects of your vacation, you should consider the negative factors that owning a second home can bring. Between costs, extra work, and taking care of another property, and the impact on other travel habits, owning a vacation home can have its drawbacks. You also may want to factor in how being away could impact your relationships back home. Before you commit to buying a vacation property, you might want to consider living there a month or two first. Spending an extended amount of time in a rental property at your intended vacation home location may provide you with a more realistic view of the area. There's no right or wrong answer on whether to buy or rent a vacation home. Please take time to weigh the pros and cons thoroughly before deciding. And please do not hesitate to reach out to Northbound Wealth Management or Brent Foster, us here at Northbound Wealth, if we can help or just be an impartial sounding board for you as you try to make your renting versus buying decisions. Thanks for listening to this week's podcast. I hope you found this information helpful and enjoyable. And stay tuned for the podcast next week, and like and subscribe, and we'll talk to you soon. Take care.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.